Well, good afternoon, everybody. As you may have guessed, I am very excited for this week's guest. I know Ryan actually quite well. Ryan and I have done quite a bit of work together in his endeavors as an industrial real estate investor. He's one of the smartest real estate guys I've ever met. He's very active, not just in properties that he's bought and sold, but also with a fund that he's now fully subscribed, and they're continuing to look to grow. So we'll talk about his selection process on how he looks at deals, how he finds deals, analyzes them. We'll go through that whole process, but I first want to just start getting some more background from Ryan on how he made the leap from investing primarily in flipping condos to multifamily, then to industrial real estate. Because I think a lot of people that already have experience in industrial real estate are pretty familiar with the process, but it's a big leap, both mentally and just getting your head around how an actual industrial deal gets structured. It's quite a leap going from multifamily to industrial. So we really want to start by diving into that, and then we'll get some tricks and tips on how Ryan looks at a deal, how he analyzes deals, how he goes through the whole process from finding it to closing it to managing it, and then ultimately even with the disposition. So there's a lot to talk about. But Wyatt, if you could bring on Ryan, and we'll start the conversation. Ryan, thanks so much for joining me.
Yeah, appreciate having being here.
Yeah, I'm really looking forward to chatting with you because I've known you quite a while now, and we've done a lot of deals together. But I think where you can really offer some insight to people is there's a lot of people, and I get them contacting me often, is they want to get into industrial real estate, but they're afraid or timid to make the leap from something that they know quite well, which is residential, to going into either commercial or industrial. So just want to get a little bit of background from you on how you started investing in flipping condos, then you bought a multi-family property, then you moved over to industrial. I think that was 2013, so almost 10 years ago, right?
Well, 2009 actually. So
Oh, so
yeah,
even
I
longer.
moved to Edmonton I moved in 2006 and started flipping residential condos. So a lot of people ask, just like you did, how do you start? Where do you start? And I always say, start wherever you can. Start where you're comfortable. And so for us, it was $100,000 condos and putting lipstick on them, changing kitchens, doing pretty remedial work and making some money. And so that was 2006, 2007, which gave me enough, I guess, capital and scale to get into multifamily and then do the same thing, renovate, reposition, and refinance. And then 2009 was the first industrial warehouse. And so industrial really stood out for me because it was frankly easier. The tenants were a lot easier to deal with, dealing with a business owner rather than than a a single tenant. It was just easier for me to deal with, and then the scale was also easier. It's a lot easier to buy 20, 30, 50,000 square feet than it is to buy 50 units of an apartment building. And so the ease of transaction was why industrial has really, since 2009, been the focus of, uh, of the business.
So how did you get introduced to it in the first place?
So I think when we were analyzing apartment buildings in 2008, cap rates were, a pretty fundamental way of analyzing, the viability of a building. And the first industrial building that we bought was a 10% cap rate. And so in a market which was commanding, a 7 or 7.5% cap, to be able to buy such a cash flow asset really drew me to it. In hindsight, I was 29 and didn't really know industrial. And when you buy a 10 cap, you're probably buying something that has some hair on it. And lo and behold, it had some hair. But that also just sort of ingrained us in the market. Showed us how to reposition assets. So within a week of buying that asset, we found out from 80% of the tenancy base that they were moving on. And so this 10% cap rate was a pretty vacant building within 7 months of us having acquired it. And so anyway, we were able to stabilize one of the tenants and inevitably did lose one of the tenants, but also backfilled it with a 30% increase in rent. And we're able to refinance it, pull the capital out that we had invested, and then continue to move on. So I think you and I, became a lot closer during that second phase of that project because I had bought that with remnant land
Yep.
and that ended up being the first development. So we were able to refinance that asset, pull our money back, and be able to deploy that to do 22,000 square feet of small box industrial base.
Yeah, that was an interesting project. We came into that later in the stage after you had already built the new addition on that site, and that's an interesting property where there's an existing freestanding building on there, and then you added condos in there, so 10 industrial condo bays in there, and you. I guess you would have bought that property 2009, right as like the global recession was underway. Was that some sleepless nights when you had bought that right under that capital
I think
crunch that we were in?
the financing that we had on it was 22,000 a month on an asset that was cash flowing about 33,000 a month. And then within 7 days, you're losing, I don't know what I was losing, 20,000 a month in revenue. So I'm 29 and I'm sitting at 100 or 150,000 of negative cash flow in the first industrial deal I've ever done. So yeah, I don't know if it was sleepless nights, but I definitely grew up pretty quick. And so I mean, honestly, you and I are friends and know each other because we are boots on the ground and we get the job done, and that inevitably is what happened. You know.
Yeah, and I want to talk about all of that because I think there's a lot of insight in your story on how you jumped into industrial, had a shock to the portfolio right away with two tenants saying that they're going to leave. You stabilized one, and that asset's actually performed quite well for you over the years. But I'm sure that there's things that you would do differently had you started right now. So, in the interest of someone that's listening that says, "I want to get into industrial," putting yourself in your shoes back in 2009, what did you do to learn about the market? How did you get comfort in saying, I understand this asset class, I understand what it is, I understand the risks, I can deploy some capital. There is some hiccups along the way, of course. But where did you get the insight and the knowledge and the wisdom just to have comfort to even go and do that?
Yeah, well, I think the first asset was really a novice decision, frankly. I saw a 10% cap rate and I thought, oh my goodness, I'm winning, everyone else is losing. And so, it was just a novice mistake. And so being able to stabilize that asset, and then it turned into an incredible success. We bought an asset for 2.5 million that within 8 months was worth 3.5 million. So again, young guy into real estate, and granted that first 2 months was tumultuous. Within that year, it was a success as far as we were concerned. And so then that gave us, I simply expanded on that existing asset. So I didn't look at different markets. I didn't look at different asset classes. I didn't look at anything other than how do I maximize my profit out of this single industrial building that we bought. And the 21,000 square foot small box industrial became really the education, on what the users are looking for, how much power they want, how much ceiling they want, how much space generally. Hey, what are dock doors or loading doors? So it was a crash course, and maybe I don't advise that it's in development, but again, I go back to start where you're comfortable, and maybe I have a high risk tolerance, but I was comfortable with where we were at with that development to start there, and then that has, as has gained, has brought us to where we are today and what we do today.
So you've done a number of projects since, and one in particular was a development you did, 40,000 square feet on 6 acres, if my memory serves, and you had broken that down into four 10,000 square foot bays, brand new Class A industrial, and that was 2013, 2014, I believe, when you had that finished. We went into a recession because we're in an oil and gas based economy, so we ran into a tough patch there. But you recently just exited out of that property as well. So the story of taking one property that had tenants in there, stabilizing it, and you still have that asset. Take me through the process of buying land and doing a ground up development for industrial real estate.
Yeah, so the 40,000 on 6 acres was really an extension of what we had done on the 20,000. So the things that, the aspects of that first development that didn't work or we didn't like, or we were, hearing, it's great, but, we could use more land, or we could use higher ceilings or heavier power or whatever it was really, my ability to go into a market that had maybe a little less cost base for land,
Mhm.
and more marketable for op costs for the tenant, and then really scale it. And so the 40,000 uh, building was divided into 4 bays, 10,000 square foot bays with an acre of land, and that's what we had heard resoundingly coming from the tenancy and the buyers from the first development. I wish the bays were a little bit bigger, and I wish we had some land. And so we really tried to build to the market. Unfortunately, in development, timing is not always on your side, and unfortunately for us, timing was not on our side on that. And so we finished in 2016, and it took, where we thought it would take months or, maybe a year to lease the building, it took a couple of years. And so not a dead stop, but not the way we intended that development to go.
Yeah, and it's still you still got it fully leased and had an exit on it, so that certainly could
I
have
think
been
it was
worth.
like a success at the end of the day.
Yep.
It's just, development from the ground up, and where we are today, and we'll get into it, is repositioning existing assets. But where I find, I'm a lot more comfortable in, but vertical development, greenfield development, infill development, it's you can't time the market always, and so there's incredible success stories, where guys are pre-selling or pre-leasing before the thing's even done. But then you also have, a development that sits for 2 years. And
Mhm.
so, you need to have, I was incredibly fortunate to have strong partners on that asset with me that could weather those 2 years. And then, yeah, I mean, a few years later, the building's leased, the cash flow is strong, the market turns around, and you get a return on that investment.
Yeah, yeah, well said. And I'd encourage anyone that has a question for Ryan. You can see that he's got a broad experience from taking assets that were perhaps not what they look like on face value, with like that first property where you had two tenants potentially leaving, all the way up to a ground up development from raw land to a finished building. And also now, with like you said, the focus is on value add, taking an existing property, repurposing it. So I'd encourage anyone that has a question for you as we're going through this interview, put it in the chat and we'll get to as many as we can. I saw Beverly had jumped in, so we both know Beverly quite well. We're big fans of Beverly. We want to thank Beverly for joining in and putting some of the links to Ryan in the chat as well. So I'd encourage people to check it out. So I want to, for people listening that are looking to get into industrial real estate, walk me through your process on how and I saw that there was a question actually, so this will be something that I weave in. We don't need to pull it up right now, why, but it just talked about how you find off market deals. So we could elaborate on that in a bit, but even if you just, how do you start finding deals? How did deals come to you, or how do you source deals, and then all the way through the process of determining which ones are worth going to due diligence? And we won't go too deep into the woods quite yet, but just those two questions: how do you find deals, and then how do you do your back of the envelope math to determine if it's even worth looking at further?
Yeah, so I think that, first and foremost, agents are a key part of our business. Investors ask me almost daily, how are you finding the deals? Similar to what you're asking right now. And while I can cold call and I can knock on doors, I'm not doing as much as the team of agents within our marketplace. And so we heavily rely on the agents within our market to be able to have confidence in an easy deal. So I think I have a reputation of being able to be easy to deal with, quick and nimble, and and so the agents first and foremost are the guys that we're looking to, guys and girls that we're looking to bring us the deals. We say no to the vast majority of them. I mean, there's obviously buildings for sale every day, and we say no to buildings every single day. So cap rates, square footage price, the covenants in the actual building, if they're tenanted, what is the usability, what is the next phase of the lifespan, there's quite a few, but I would, in the assets that we bought in the last 2 years. So we bought, not to jump ahead, but we bought or under contract with just under 200,000 feet. So
Mhm.
in the 200,000 feet, I would say that the math on those assets were really what I just said. The covenant was a cash flow asset, and so the tenant in that building is a well-heeled, strong operating business, and they just simply chose not to own the real estate. They absolutely could own the real estate, but a lot of businesses are better served to spend the money in the actual business than they are in the real estate. So let that be, my job. Square footage pricing. So what, buying at a wholesale price and being able to, with one of the assets that you're familiar with, being able to condo convert and sell at a retail price was a metrics on one of the assets. And then simply, usability, what the building can and will be used for, and have all been the core of how we value and look at the buildings.
Yeah, you bring up a really good point there that I get asked this question most often from people outside of the industry on why large companies lease real estate instead of just owning it. And Amazon's a good example that they have billions of dollars in the bank. Why can't they just own the warehouses that they have? But to your exact point, where is their money best served? Is their money best served tied up in the real estate, or can they use that money to grow other product lines or other divisions or expand into other areas? And that's not just Amazon, that goes all the way down to the small mom and pop shop. Is their
Yeah,
money
absolutely.
best served in the real estate, or can they expand and can they make a better return within their business than they would within the real estate? I think once people understand that there's an opportunity cost for your money, and you should be able to earn a better return within your business, otherwise get into the real estate business and don't run your business, then that money's just better tied up there. So I agree with you. That's a bit of a tangent, but I think people do need to understand that there's an active market of large companies that large, medium, and small companies that want to lease their space because it's a better business decision for their own operation. So a really good point on that. So let's say that you found a property that you've identified as a candidate, and let's say you've toured it, you've done some preliminary math on it, and it makes sense. So now you've got an offer negotiated. Let's jump ahead a few steps, and you've got the offer negotiated. You have a conditional property. For people that aren't familiar, they might be a little bit different than the residential side, where that could be a lot easier of a process. What's the process involved in due diligence? And you can give some abstract numbers on time, cost, process on this, to just give people a better understanding of what's involved in the due diligence.
Well, standard offer that we write, which you're aware of, is a 60-day condition period and 30-day close. So I think once you're done your conditions, there's really no impediment to closing. I think it does take a solid 60 days to do due diligence. It may take longer, it may be shorter, but I think 60 is probably the right time frame to be comfortable in getting them all done. Building condition reports are fundamental for lenders. Environmental reports are fundamental, and appraisals are fundamental. So those are the three necessary components for industrial real estate right now. There will be, other, reserve funds or the covenant or who the purchaser is, and what the group of investors look like. But I think the three core due diligence items for a piece of real estate would be environmental, BCA, and appraisal.
So
And
let's
then
break.
in terms of your leverage, I don't know if I'm jumping ahead of you, but in terms of your leverage, I would, we underwrite deals with the expectation that's going to be 30% of equity required. So you buy a $3 million asset, and we think it's going to be, cost minimum $1 million of invested capital to go into that building. If the building condition report comes back and says there's $500,000 of work that needs to be done, that would be an add-on. You may get financing at a 70% leverage, but more times than not, the lender wants to see that you're actually doing that work yourself. And so in that case, it would be $1.5 million into a $3 million asset.
So I do want to elaborate on those reports a little bit more. You and I are in this business. We see and talk about these reports on a daily basis, and we're very familiar with it. For someone that all those terms that we might have mentioned might have went way over their head.
Sure.
Let's start with the BCA. Some I've even heard it called a property condition assessment. So either building condition assessment, BCA, or property
Yeah,
condition
so building
assessment.
condition assessment, BCA, it'll address the envelope of the building. So it'll address your roof, the age of that roof, what kind of material is that roof, when it should be replaced. If you're getting the proper BCA, it should give you a 10-year lifespan, and it should pull out what the capital cost should be to fix any issues if there are any within that 10 years. And so a lender, if you're getting a 5-year fixed term loan, the lender is going to want to know what needs to be done in that 5 years.
Mhm.
If it falls in year 6 or 8, they're a little less concerned. But if it's called for in year 1 or 2 or anything within that, with anything within the term of the loan, they're going to want to know that it's being resolved, so that they're able to, sell the building, that they're able to get their money back. So roof, envelope, windows. It'll talk about the structure within within the building. So with industrial, your slab and usually the thickness of your slab and the quality of the slab. They'll talk about your plumbing, your electrical. What components are your plumbing? What kind of components are your electrical? One of the ones that we just dealt with was, the lender wants to know that there's no copper wiring in in the building. And so, I can lay eyes on it. I can take a picture. I can send it to a lender, but they would rather an engineer obviously see it in a report. And so
Mhm.
your BCA will address, the components of your wiring, your plumbing, what kind of HVAC system, heating system that you have, the age of those, when they need to be replaced. So it's really a full picture. I mean, if you're looking at a building, I at the beginning of my career, I always found them to be uh, a pain. Like you're jumping through a hoop to satisfy a lender, and I don't necessarily care as much as a lender cares about these reports. And you fast forward to me now. I mean, we rely on those reports wholeheartedly. And so when they're calling for a roof to be replaced, it's going to be $400,000. And I think, oh, that's 10 years ago, I thought, oh, well, that's going to screw up my financing. Now I think, well, that's a roof that actually probably needs to be replaced. So it's, they're important pieces for analyzing building. Environmental, similar thing. They're just testing. So environmental is more of a record search, and it's a record search on what's happened on that property. And so if they come across anything, like if it was a oil and gas user or anything that could have been a contaminant, paint shop, anything that would have added contamination, then they will call for a phase 2, which is boreholes throughout the property. So they'll test the soils throughout the property. If you have a negative phase 2 report, then you have to do phase 3, which is a scope of work for remediation. And so none of that, they're all just hurdles, but they're also education for you on getting into a building. You don't, financing obviously doesn't want to touch a building that has environmental, but honestly, as an investor, as a user group, you don't want to touch a building that has environmental issues unless you have a very clear direction on how you're going to remediate and fix those problems.
Yeah, well said on that. And then, not to put words in your mouth, but I'm sure you'd agree with this as well, is that even if you weren't getting financing, if you were buying that property all cash, you'd still want to commission those reports.
Absolutely. Yeah, absolutely. I was just talking to an investor, an hour ago, and they said that they underwrite their deals with no leverage, and so every deal that they look at is as they underwrite it to make sure it makes sense. It's an unlevered deal. And so their due diligence items are exactly what we talked about, but it doesn't hinge on the financing component. The reason we like financing, as everybody does, is the multiples on return that you can actually get when you succeed at what it is that you're doing. And for us in the repositioning and value add game, it really allows us to multiply invested capital.
Mhm. So let's talk cost and timelines, fully disclosing that it couldn't vary across markets. Whether you're tuned in Vancouver, you're tuned in Florida, the markets can vary vary, and the time and the cost can be different. But just as a general idea on what you're seeing on time wise, and assuming that all markets are going to be somewhat similar, what are you seeing for costs on the BCA, then phase one environmental and an appraisal?
Yeah, so I would say, we use two or three different companies. And in our market right now, everybody's incredibly busy. And so we're giving them about 5 weeks from go to have a finished report. And there's times where we'll get it next week. Appraisals tend to be very quick. I'm able to get an appraisal probably within 10 days, if not a week.
Mhm.
But then the BCA and the environmental, we're using this, whatever group we go with are doing both of those reports, both the environmental and the BCA, and we're finding that it's about 5 weeks to get those reports back. And so, the 60-day window that we're talking about in terms of our standards, purchase agreement, gives us that ability to uh, get the report done, finalize, tweak the things or ask the questions to the engineers that were unclear on or unsure or what simply weren't answered, and then provide that to our group, whether it's financing or investors or whomever that might be, to analyze it, and then become in a position to be comfortable to remove conditions and proceed.
Yeah, and then cost wise, not to
Yeah,
hound
sorry.
you on that,
Cost
but
cost on environmental would be, I call it five, like call it $5,000, I guess, for high level numbers. Every report, budget $5,000, and
you know,
you probably do better or marginally worse. But if you're budgeting $5,000 per report, that was the other thing. At the beginning of the career, you think, oh my God, I'm going to spend $15,000 on 3 reports to buy a, even at the beginning, you buy a $3 million property. I hated that. I hated that I had to like spend $15,000 to do the due diligence to buy an asset that I really wanted to buy. And education is formed on the people that have been in the market for a long time, and for the young people that are tuning in or will tune in the future, that's money well spent. And it's they're needed reports, and you should rely on them as you rely on mentors to educate you on the properties that you're looking at, and so.
I do want to talk about the value of mentors later on as well. So I'm glad you brought that up and planted the seed for that. I agree with you completely on that. Is that you look at the process of spending 10 to 15 grand, and then you're going to probably have a lawyer in there reviewing documents, or at least you should have somebody, unless you're very familiar with it yourself. You're going to have legal fees in there just as part of your due diligence. But I think that that's one of the most surprising things that new investors have getting into industrial, is that it can be a 2 month process of just compiling all of your due diligence, and it's going to be 10 to 15 grand in there of cost. So it's a natural barrier to entry, and I think that that's why, in one of the reasons anyways, on why industrial offers more lucrative returns than other asset classes, is because it does take a learning curve and a process to go through it. So I guess that could lead me to the next question that I have, just on how you start looking at a deal from a return standpoint. Obviously, cap rates have come down. I don't think there's many 10 cap properties, at least I haven't seen many recently. So when you're looking at a deal, how much weight are you putting on a cap rate, and then what is the process on how you're trying to build out a pro forma for like a longer term hold on it?
um So we rely on cap rates, like as a value, as like an end value, or as complete a value. We'll rely on that. I think that maybe rephrase the question to give me a bit more direction on how to.
Yeah, how are you building out a, call it a 5 or 10 year pro forma, and trying to figure out what your internal rate of return is over that period, or are you just looking to stabilize the cash flow and apply a cap rate to give you like a rough idea of
Okay.
value at that
Yeah.
point?
Yeah. So no, I mean we immediately look at an asset and the usability of the asset, whether it's cap rate or a per foot or the covenant of the tenant. We look at the usability of that building, and so granted. And so we go into it with at least a 5 year
Mhm.
projection on what that building is going to be. And so if it's going to be empty, I mean, we buy buildings typically that are chronically troubled. And so whether they're vacant or they have, you know, they need renovations or whatever it is, I mean, we're buying problem assets, and so we absolutely need to know uh, or be comfortable on where that asset's going to go in the next 5 years in terms of the market and what users are looking at. We do look at IRR, and so we don't necessarily have a threshold, though we're in a new fund here that I'm sure we'll touch on,
Mhm.
and it has a high watermark that says we as operators are paid more if the IRR is higher than X, and so internally we want to do well by the investors, but we also want to do well by us. And so, but more than the return on the actual like capital invested, it's the function of the building, because you're only going to lose if the building doesn't work. And so you can't control all the factors, but you can control your analysis on the usability of the building.
And then on related topic on that, how are you looking at your downside risk on this as you're going through that process?
I think that's part of the usability, right? Like I
Mhm.
think the downside risk is, what is the worst case scenario? And so we don't really analyze a building based on thinking it's going to sit empty for 2 years. We analyze a building saying, what is the lowest rate that we would have to charge to backfill this building? And so that is really how we govern the downside risk. And we, like again, I keep talking about before and later, thinking I have too much gray hair in my long established career, but I used to always want the most leverage as possible, and have the least amount of equity going into it. And while you have maybe a stronger return when it goes well, you have a lot more leverage, a lot more debt, a lot more risk when you have those high leverages. And so we try to balance that. We try to balance 70% or lower loan to value to keep our capital costs low on financing the buildings.
Yeah, and that is a critical part with investing in general. Is you should have a really good understanding not just of what your upside is if everything goes well, but what is the downside if things don't go well.
Right.
And you've had examples of that where things didn't go as according to plan, but you had a contingency plan and were at least prepared for those things, and you were able to ride it out until it was in a better position to take advantage of it. So I think that's a really profound thing to note on there. I just had someone ask me a question about reports, and they said, "What happens if there's already reports on the property? So maybe the seller has a BCA or an old appraisal. How do you and it's obviously case by case, but how do you treat that if there's already reports on the property?"
We'll rely on them. I mean, so internally, we'll rely on the reports that are existing, regardless of age. Whether they're 5 years or older. We'll look at those reports and give us a clear indication. Environmental is the biggest one. So if a building, excuse me, if you have a building condition report that's 5 years old, it'll give you a sense on like what the building's at. But if the environmental 5 years ago shows that it is contaminated, and there hasn't been a scope of work, a phase 3 to remediate that site, that's a sort of a pause moment to say, well, how serious are we on this asset? Can we deploy capital somewhere else? In terms of using it for financing and actually using it for financing, because you can use whatever report you want if you want to close in cash, but if you want to close in with financing, they're going to, you'll have some lenders that will accept an 18-month-old report. Most lenders want to have a 12-month or newer report, and so you can simply ask for a transmittal letter from the vendor, from the seller, to ask their engineers and the people that did those reports to provide a transmittal letter for you and your finance arm. That's the easiest way. It costs a few $100 to get those letters.
Mhm.
That said, we went through a acquisition in December. The appraisal was, I don't know, I think the appraisal was like 9 months old. And the appraiser, because of the market we were in at the time with COVID and whatnot, wouldn't provide a transmittal letter. They wanted to do a full analysis, so you might argue it's cash grab for a new report, but you also get a sense. I mean, they have the liability on providing a report that they believe is accurate, and so even the people doing the report required that we do a new report with them within 9 months.
Just talking about the environmental, just before we move on, we talked on reports for roughly 5 grand in a few weeks to maybe a month for phase one. Phase two, like you mentioned, you're actually going in and you're boring holes. They're testing that soil in the lab to see if there's any contamination. So if there's any levels of something that's beyond the threshold established by the governing body, then it could be contaminated. I know you've done phase twos. Have you gone to a phase three before?
I've only bought no, so I haven't personally. I've bought one of the buildings that we bought in the last year actually went through a phase four, and so it was an education for me just within the last year of a group that so they were end users, they were the tenants in the building
Mhm.
or owners of the building and operators of the building, and then and so they treated it as if it was uh, their own asset, and so they at the time that they went to sell it, which was a few years ago, they started doing all the reports. So phase one, phase two, I don't have timelines on it,
Okay.
but they did a phase two, which called for a phase three, which is scope of work, which had, I forget what it was, about 80 cubic meters of soil to
Hmm.
be torn out. And there wasn't cost analysis, but I'd put that cost at about 400 grand.
Well,
And so, I mean, it wasn't a small job. It was, and frankly, I mean, 80 cubic meters is like not that much dirt. It's like you can eat up a lot of dump trucks with 80 cubic meters. So um, anyway, they like the phase four, I believe, is the one that shows you that it's been remediated and cleaned.
so I think that's worth emphasizing to anybody that's looking into this is it can become very complex as you're going through an industrial purchase, and that's why an investor like Ryan has a team that's working on this, an environmental consultant that's walking through this process. The last thing you want to do is buy a property that hasn't had a proper environmental report done to find out that it's going to cost $400,000 to remove 80 cubic feet of dirt. So that I just wanted to echo that comment because I know we've dwelled on that a lot, but it can become very daunting as you start going through the process of getting a building condition assessment, a phase one, two, three. I've never been involved in a phase four. That's a scary proposition in itself just to see that process underway.
I think
And then
typically we steer away from environmental issues, right? I
I
mean,
was
there's
going
a
to
lot of
say
guys
that
that
too.
will talk about how they can remediate like effectively. The market that we're in, the city gives you grants for brownfield like sites, contaminated sites. Our city will give us, some money to remediate those sites so that you can develop on it. We typically find it to just simply be easier. There's
Mhm.
easier deals in the market than having to, like we're not in a shortage here, and so we typically look for easier deals,
The
and we'll steer
vast
away from.
majority of investors that I've spoken to over my career have said the same thing, is that if a phase 2 indicates that there's contamination, it's just on to the next property. You
Yeah,
can
I
spend
think you
so
and
much.
I spoke about a property, within the last 6 months, and it was, it's on the market at 1,500,000, and it's on the market for 1,500,000, and and it has a valuation of like 7.5 million.
Yeah.
But it's still not worth it, because you don't know how deep that rabbit hole can take you. You know.
Yeah, I mean, if you spend $5 million, and that one had a considerable amount of contamination just from the operator that was on there, you could spend $5 million just chasing that problem, and
That's
you
right.
still
Yeah.
might not even know. So yeah, it was a property that was selling. Yeah, you're right. It was. I think those were the numbers, 1.5 million, and it had an appraisal on it that the extraordinary assumption was that there was no contamination. And I think that maybe they just had like a preliminary report or an estimate of value done on it that said that, but nobody touched it. Nobody wanted
No.
to take on that risk. So, yeah, just to echo what Ryan said, there is just make sure you're doing all your due diligence on this because I think that's really important. We had a question come in from Pat Wyatt, if you don't mind pulling that one up. Pat, thanks for joining in. And the question, good info. What would you say is the minimum square feet that you would suggest going after when first starting out buying an existing property?
I don't think there's a size that's too small. I think that you need to chase what you think is comfortable. So whether that's I don't know what small is, if that's a 500,000 square foot, industrial condo bay, and the numbers make sense. I think that's great. To jump ahead to what we're doing in Artisan, but we're chasing buildings between 3 and 10 million, because we find that to be opportunistic. You were talking about a barrier to entry, because of the reports, and as the costs of the properties go up, the barriers become higher, and so we're capitalized and able to deploy more money than we were able to 10 years ago. And we find it pretty opportunistic to look at properties that are a minimum of 3 million and then upwards of 10 to 20 million, frankly. But I wouldn't use that as a limiting factor. I think that if you can find a great asset that's $500,000 or whatever it is, that's a great place to start.
Yeah, first one I ever bought was a $400,000 industrial condo, and that was in 2014, and we still own it. Still, we had 1 month of vacancy in that entire eight years that we've had it,
Yeah.
and it's been a great investment. It's building the whole building's been refaced, and there's some work that's gone into it. We've chased bigger deals ourselves since as well, but that's still been a great investment, and to get your foot in the door. I agree with that point you made earlier, Ryan. Was that I don't think there is anything too small either. As long as the fundamentals make sense and you can justify the money that you're deploying, and then also just that you're committed to spending the amount of time required to really understand the market, your local market, as well as just the asset class. You talked about that earlier, Ryan, about just some of the important things to tenants, and that's another great point that perhaps we could just spend a minute or two on. What you consciously did that very early into your career as an industrial investor is that you looked at what the market wants, and you've alluded to that you surveyed people, you surveyed tenants or buyers, you talk to brokers all the time. What would you say are some of the key things that industrial investor, like Pat, who wants to get started, what would you say to Pat that he should be looking for in a building? Speaking from a fairly high level, because obviously every market's going to be a little bit different and unique, but speaking from a very high level, what are some of the important things you found to be in industrial real estate that's worth paying attention to?
Yeah, so I think that, like, first and foremost for Pat and whomever else is listening, your market will have specific fundamentals, and what our market and different markets have, there might be some overlap, but so I'll only simply speak to this market, which I think has some translation, but manufacturing needs heavy power, and so you definitely want to, like, if you're in a node that has manufacturing, you want to be able to supply heavy power to that site. So I think that we tend to find 400 amp to be sort of the minimum if it's going to be a manufacturing facility. Slab thickness is like a big component. So if it's heavy user, they tend to want like a 7-inch slab, and even if they don't fundamentally know the slab that they want, you also don't want them coming into your building and breaking your slab. So you want to know what the use is, so that you know that they're not going to trash your building. Thick slab, storage and yard is big components. A lot of people are looking at security right now, and so LED lights and security fencing matters. Operating costs, and so what is it going to cost to service that building? Do you have remnant land that's not actually generating cash flow that your existing tenants aren't using, but will end up having to pay, whether it's property tax or landscaping or whatever it is? So, I mean, you have to be cognizant on the cost to the tenant. Distribution needs ceiling height. Bay doors are a big thing. So whether you have grade or dock loading doors, self levelers if you're gonna have dock doors. So there's a lot of, in our market, we have a lot of older assets that have dock doors that with no levelers, and so that becomes like I think the last quote I have was $13,000. And so if you're at $13,000 for a leveler and you have 15 doors, I mean, that's a pretty major cost to get you to sort of square one. You're not dealing with the roof or the grading or anything else. You're simply, getting the building up to snuff. Power, roof, yeah, light, security, I think those are probably pretty universal throughout markets.
Yeah, I would agree with you on that. I think that those are important, whether you're a manufacturer or a logistics company. What I always encourage people to do is whatever their market in is just start studying what's available. So you can go onto any of the major brokerage websites in your specific market, start looking at the properties that are available, and start noticing what's being mentioned. So it might say loading 10 dock doors. They might have both. They might have dock and grade. There might be a certain ceiling height that's important. Some of these newer markets, we're starting to see 32 and higher, whereas other properties, it could be 18 feet, and that's adequate for the market that's there. So just really start paying attention to what the market is, and what if any property that you're looking at, you just want to be competitive. And if you don't have something that every other property has, what's the cost to fix that so that you are competitive? And I think if you take that mindset of just knowing any property that you're looking at is competing with all the other properties. So you just want to make sure that you don't have anything or you're missing something that other properties don't have. So, sorry, anything to add on that?
I think that, one thing that, has become really transparent in the last couple of years of us looking at buildings is that, tenants want ceiling height in our market. And so they want high ceilings for racking and storage. But their reality is that they don't actually have insurance above 16 feet unless you have sprinklers. And so they will, a tenant can be their own worst enemy at times, and you need to be their advocate. And so, if a tenant is looking to do racking, the building in Ashton that we talked about was 28 feet. There's not a single user in there that's using 28 feet,
Hmm.
and no one has sprinklers. And there's a cost to sprinklers. I mean, we're under contract with a building that has sprinklers, and we're pursuing it as distribution because it's defensible. So, I think I only bring it up because I can almost guarantee that in any market, ceiling heights are going to be a topic, and it'll be a topic because of distribution and where we're at with the world of distribution. But know that at least in our market, and I would assume that's pretty universal, is that over a certain height, and in our market 16 feet, they don't have insurance unless it's sprinkler. And so unless you're going to put sprinklers in there, or you're going to provide a TI for the tenants to do it, or they themselves are going to do it, buying a high ceiling height building actually has no value unless you're actually going to add that secondary value to it.
Yeah, and if anything, then you've got increased costs of heating that cubic footage versus a building with
Sure.
20,
Yeah.
20 feet is going to have much less of cubic footage to heat. So it not only is there not necessarily any value for the tenant using it, but they're going to be paying more in operating costs as a result. I want to move on because I still want to get your talk to you about Artisan and just value of having a mentor in this space. But there's a few other questions that came up. Wyatt, if you can bring up the one from Graphics Equip. Oh, yeah, thank you. Thanks for joining as well. I always appreciate your support and questions. How are lenders scrutinizing environmentals? Great
They
question.
simply look at whether there's a phase, so if a phase one is a records check calling for a phase two, the lender is going to require a phase two. And like we had talked about earlier, I've only ever bought a phase three and a phase four building. I have never actually gone to a phase two and had those core samples tested and they come back contaminated. And so that typically for me, and having bought quite a bit of real estate, has been where it ends. And so they scrutinize it only insofar as to know that it's past the phase two environmental.
Yeah, and like you mentioned earlier, it just comes down to risk for the lender. They just want to make sure that if anything went sideways, they're not taking back a property that has an unknown cost to remediate. So what I've found to be the most effective is if you have a report that clearly and definitively says no further testing is recommended, and that report was done fairly recently, like last few months up to maybe a year and a half, that's usually sufficient. But if there starts getting any wishy-washy language in there, or if it's a 2-year-old report, all bets are off. You might have to do further testing or get an updated report.
That
But
tends
yeah,
to be that tends to be like an issue as well with the engineers, right? Where they don't want to give you concrete language, and you as a team and financing, but you as like a buyer want concrete language. I mean, you want it to know that it's it's clean, that you can proceed. And so we lean on our engineers to provide exactly that. We had a report. Most reports will say conclusive, no further testing required, but we have had, a handful of reports that come back saying, well, you may want to look at this in 2 years from now. And we either, get them to either solidify that is in fact the case, or, they were just nervous about giving a concrete report to say like no further testing required.
Yeah,
If there's not a, we're looking at a site that ended up becoming, like, we ended up finding out it was contaminated, and didn't pursue it, walked away. But in that process, talking to a few people that leading into mentors, talking to some mentors, they said you want to know that the contamination is not still happening, and so if it's, I have friends that have 5 acres on the south side, and the city was pooling snow on the city's land, but as the snow melts and the salt drains into the ground, it actually contaminated the adjacent site. And so that would be a building or a site that is not going to continue to be contaminated, right? And so you need to know that whatever caused the contamination is not going to continue to cause the contamination.
Mm-hmm. So next question, I think actually ties into this mentorship one. Wyatt, if you don't mind pulling up that one from Neil. Main reasons you switched from multifamily to industrial investing, and how did you start educating yourself on industrial? I think you touched on that at the beginning quite well, but I do know that you've relied heavily on mentors to take yourself from an investor that switched from multifamily to industrial to where you are today, where couple 100,000 square feet, you're looking to add another $15 million in the next year or so here. What was the value of having a mentor? How did you find one? And how could someone find a mentor in their market if they wanted to take their game to the next level?
Well, I've always, looked for the individual that, is like-minded and senior to me. And so for me, there's not a ton, but there's a few individuals that are, 20 years my senior. And I feel like we're exactly where I am, or, maybe a bit ahead, maybe a bit behind, but very much, it gives me, sort of the line of sight of where they are now. And, I was thinking about that earlier, and I was thinking that, anybody that's older and successful really respects ambition, and they really want to look after, I feel looked after, honestly, like they don't want me to make the same mistakes that they made. And so they're not going to hold my hand throughout the whole process. I can easily call, a few guys or a few individuals and simply say, what do you think? And just like, a 30-year-old can call me and I can answer a question really without thinking, they do the same for me. And so it's been incredible, honestly. I feel incredibly fortunate to have the individuals around me. So there's no formal agreement. There's, it's just simply finding the people that you mesh well with, that respect you, you respect them, and so I think that, NAIOP Edmonton, or NAIOP, is like a organization that we're familiar with. And so there is a mentorship program. And so I'd say any market has some sort of commercial real estate organization within it. And that organization should, if they don't, they should have a mentorship program. And so get on that. It's a good place to start.
You and I both served on the board of NAIOP, and I recommend it to everybody. I think it's one of the best values that somebody involved in the commercial or industrial real estate sector can get into. Membership isn't crazy expensive. You're getting access to industry leaders in your local market that, like you said, are often very eager to help or steer you in the right direction. So that's one thing that one of the first things I recommend to people when they ask how they can get more involved is look for a NAIOP chapter. I think I don't remember offhand, but I think there's close to 50 chapters in North America.
There's a lot. Any major market. So I'm sure we have some markets tuning in or we'll stream this at a later case, but within a general proximity of where most listeners are, I'm sure there's a NAIOP chapter.
Yeah, and I couldn't reinforce that more, is that there really is a lot of value in NAIOP for no other reason than you get access to some leading edge information that they produce, and the mentorship value that they have is tremendous as well.
What's our commission on this plug for them?
Yeah, we should be free membership maybe for 2023. We'll have to send an invoice for that. Oh, thanks, Beverly. She put the link to NAIOP in there as well. She's on the ball. TCS, thanks for joining in. Always appreciate your questions as well. Are you experiencing negative leverage in your market? That's a great topic right now. And what's your debt financing strategy?
We signed a 4-year fixed term at 4.65 the other day. And I was telling an investor, before I jumped on this call, that's probably 150 basis points above where it was 6 weeks ago. And he was lamenting that it's probably 225 basis points of where his market is from 7 weeks ago. So I mean, the markets are changing, and the cost of capital is changing. I think that we are trying to go into every property eyes wide open. Our strategy is a reposition strategy, and so the money that we are the 4.65 is a stabilized refinance of a repositioned asset. And so when we go into an asset, we're not expecting cheap money. We're expecting to be in and out, but we do need to have a clear sight on what we think the interest rates are going to be, and that's a moving target right now. And so we're starting to underwrite at 5%, but whether that's 5.5 in 6 months, whether it stays at whether I'm still able to attain fixed price money under 5%, I'm not. I don't have a clear answer on that.
And on the debt side, you're looking to put down 35%.
We're looking at 30% minimum. There's times where the asset is incredibly valued over what the purchase price is. It's been an opportunistic purchase, so we will put higher leverage to cost on the asset, but it will still fall under a 70% loan to value. And so there are times where we'll use high leverage on an acquisition, but there's still, call it a 30% equity component between, appraised value or market appraised value and the debt load on it.
Mm-hmm. So you've been investing since 2009. That's even longer than I thought it was. So you've earned those gray hair in your beard. That's for sure.
Gray? Yeah.
Well, a little bit. It's a little bit. You look distinguished though.
Yeah, thank you.
So you recently, I think it was in 2021, if maybe I've got my dates wrong on that, as well, as when you started Artisan Industrial.
Yeah, so Artisan started last year, 2021, and so I've been in the game of buying, refurbishing, and repositioning industrial assets for more than 10 years. Yep. We've had vertical development in there, but the biggest wins and where I feel like I'm the most successful and frankly the smartest is buying assets that have issues and being able to reposition them and tenant them, refinance them, or sell them. And so Artisan started last spring under the Artisan Industrial brand, and the goal was to raise $5 million and buy about $20 million of real estate. And so you fast forward 10 months later, and we've raised that full 5 million, just under 5.3 million is raised, and we've bought just over 15 million, and are on track to buy probably about another 10 or 15 million with what we still have on in the bank and with the refinances that are coming through. And so it really is just a scale of what I've been doing for the last 13 years is buying. There's really no difference. The price target is 3 to 10 million, and buying assets that have either they're chronically vacant, the owners simply don't want to manage it, or end users simply want to buy, or there's legacy that, the first asset that we bought, it was legacy. So it was, the parents ran the business, owned the real estate, want to retire, and the kids run the business, have no interest in owning the real estate, right? And so being in the market with agents and just kind of knowing what's going on, put that deal in front of us. Um, so.
So are you're fully subscribed on your first raise? Are you still actively looking for investors that want to be
Yeah,
involved in real
absolutely. Yeah.
estate?
So I think that, yeah, so exactly. We started raising capital last summer. And so the investors that are first in wanted to know that there was a horizon on raising capital and a horizon on the actual fund itself. And so it's a 5 to 10 year fund and $5 million. So the guy that, invests $250,000 in September wants to know that we're not still raising money and still sort of dragging his investment out. And so we put a fine deadline at the end of February of 2022, where we would raise capital till the end of February 2022. We extended it till the end of April so that we would be fully subscribed, which we succeeded in. And again, to buy probably another 10 or 15 million of real estate within that fund. And immediately we're already we haven't branded fund two because we still need to finish this first fund, but people ask like what's the extension of deals that you see within our market, and I think it's about 80 million. And so I think I'm not shy of our current market right now, and so I think that we're going to continue to go, and maybe we'll see a restraint on deal flow and what is viable deals for returns before we hit that 80 million. But right now, I'm pretty I'm optimistic on how far we can go. So yeah, there is no stopping, I guess, of raising capital. It's just onward and upward.
So I want to end by getting your outlook on the industrial real estate market. And I know that there'll be some location specific assumptions and comments that you'll have on there, but even just the case that you would have for somebody that perhaps might be speculative or concerned about putting their toe into the industrial real estate water. So I want to get your thoughts on that. But just before we close out on that, we have your contact information, both your LinkedIn and Artisan's website posted in the description. So I'd encourage people to reach out and talk with Ryan. And if you're interested in investing in his fund, the website's there as well. And I'm sure Ryan would be happy to talk with you. But closing out, what's your outlook? What's your sense of the market? How would you say to someone that wants to get in, but they just need that little push? What's industrial like in your mind?
Well, I think that I keep saying it, it's probably the third time, but start where you're comfortable, and regardless of size and regardless of capital that you have, ready to go. I think that you need to start wherever you can start. We're optimistic about industrial. I think that the market is changing. It's interesting because the market probably 2 years ago in our market, but probably North American wide, has shifted more into distribution. And I think that with the lead times that everyone's experiencing right now with trying to get stuff from overseas, I think that manufacturing is actually going to come back to North America. And so I think, it's probably smaller. It's probably a little bit different than what, manufacturing looked like 20, 30, 40 years ago. But I do think that there is opportunity both in distribution and manufacturing, and optimistic about our market, optimistic about North American wide, really.
So wise words to end on, my friend. Thank you so much for taking the time for
Yeah, I
this.
appreciate it.
I really hope you actually do some more podcast shows. You got a ton of insight and wisdom to offer. So I hope you do some more of these down the road, and I'll definitely invite you on for a future episode as
Well,
well.
thanks for having me.
Thanks again, Ryan. Appreciate it.
Okay, take care. Thanks.
Bye.